Hello everyone, today is 13th of August and I am here with today's analysis. In this program, we tend to cover topics in a holistic manner, topics which are recurrently in news and are very important. Very important from prelims point of view as well as mains point of view. We also tend to cover them holistically so that after watching and after reading about these topics, you will be able to answer questions in prelims as well as mains. So let's begin today's analysis. We will be covering three topics today. The first is very important, RBI keeps the repo rate unchanged. In this topic, we will be obviously covering what is repo rate. But why does RBI, increases or decreases repo rate? The answer to this question is it has to target inflation. Its responsibility is to target inflation, that is. So the basics of this we will be learning in this particular topic. And not only the basics, we will also be looking into the recent trends of inflation, the recent trends of repo rate, what are the future projections with respect to inflation, and many other things which are relevant with the topic. Then the next is gig workers. Gig workers are those workers which are not in the traditional employer-employee relationship. They do the work and whatever work they done, they get the payment for that. Those are contractual basis workers. Like for example, all of you might have used Zomato, Swiggy or Ola, Uber. The drivers in Ola, Uber get paid on per ride basis. The delivery boys in Zomato and Swiggy get paid on per delivery basis. That are gig workers. Why was it in news? It was in news because the government wants to ensure the welfare of these gig workers. Since they are not in the traditional employer-employee relationship, they do not have extra benefits like paid leave or insurance from their employers, or provident fund or pension fund is not available to them. So they are more vulnerable to economic shocks. And that is why the government wants to ensure their welfare. So in detail we will see. And last is PM Swanidhi. This particular scheme is for the street vendors. The street vendors were the most impacted category of people during the COVID-19. These people, they are there on the streets selling us various, I would say, items like, they put up food stalls or they sell vegetables and all. They were the most impacted during COVID-19 and the government came up with a scheme for them, that was Swanidhi. The scheme per se was started in 2020. But why was it in news presently? Because the government has set a target for disbursal of loans till the end of this year. And the government of India has set a target to disburse at least 63 lakh loans to the street vendors by the end of this year. Has it benefited the street vendors? Yes, it has immensely benefited the street vendors. What kind of loans are given? What quantity of or what amount of loans are given? We'll all see in this particular scheme. So let's begin with our first topic. Now, what is repo rate? You need to understand this. Okay. So it is the interest rate at which RBI lends money to scheduled commercial banks. Scheduled commercial banks like SBI, HDFC, ICICI, then we have PNB. All these banks where you, me, go for availing banking services are called as scheduled commercial banks. And when these scheduled commercial banks, they want money with them, they can go to the RBI. RBI does not give money for free. RBI says take the money, but you have to pay interest on it. And you have to keep something as collateral also. So whatever securities you have, whatever assets in paper you have, you keep those assets as collateral, take the money, give me the interest rate on that money. When you give the principal amount back, you can take the assets back from me. So that interest rate which RBI is charging to the scheduled commercial banks is called as the repo rate. Now, why does scheduled commercial banks want to take loans from RBI, or why would they take loans? To manage liquidity. And what happens to, can RBI increase or decrease repo rate? Yes, it definitely can increase or decrease repo rates. In what circumstances it increases or decreases repo rate? It increases or decreases repo rate to tackle inflation. Now you must be wondering, inflation, repo rate, what is the connection? So to understand the connection, let's go to the blue board where we'll see the connection. As we all know that RBI increases or decreases repo rate to tackle inflation, which also means that tackling inflation is the responsibility of RBI through monetary policy. I'll explain all this, don't worry, but let's first understand what inflation is. Inflation is simply price rise of goods and services. Now, why this price rise happens? This price rise happens when there is a mismatch between demand and supply. Mismatch simply means when demand is more, supply is less, inflation increases or prices increase. When supply is more, demand is less, prices decreases. So inflation reduces. So if there is a mismatch, then inflation happens, particularly in that scenario where demand is more and supply is less. How demand is more or why demand will be more? It will all depend on the money supply. If the money supply is more, means people are having more money in their hands, they will spend more money. When they will spend more money, means there is more demand. If there is more demand, then there will be inflation. Now, more money supply is tackled by RBI through its monetary policy. Monetary means money. How does RBI, tackle the increased money supply? If increased money supply is tackled by RBI, it simply means that RBI will be able to reduce the money supply in the economy. And if the money supply is reduced, inflation will be reduced. How does RBI reduces money supply? Through its monetary policy. Now here comes repo rate into picture. RBI will increase the repo rate. RBI will increase the repo rate to reduce the money supply. Repo rate increases money supply reduces. Now, how this happens? What is the connection? Repo rate increasing, money supply reducing. Money supply reducing means, money in circulation reduced and inflation tackled. Now, how this happens? Repo rate, as we all know, RBI giving loans to scheduled commercial banks. It is that interest rate. Okay. Now, RBI increases the repo rate to reduce money supply. So, RBI has increased the repo rate. Let's suppose the repo rate earlier was 4%. Now, RBI has increased it to 6%. Let's suppose. Now, these scheduled commercial banks will think that taking loan from RBI is expensive now. Earlier it was available at 4%, now it is available at 6%. These scheduled commercial banks will start thinking of other options from where we can get the money with us. So these scheduled commercial banks, they have some financial instruments. Financial instruments like FD. We all know fixed deposits, like you all and me, everyone invests in fixed deposits almost. You park your money, you get interest rate from the banks. And on these financial instruments, let's suppose the interest rate was 4.5% earlier. It was 4% or it was 3.5%, let's suppose. The interest rate which the banks used to give us when we invested our money in the banks in FDs was 3.5%. Now, what the banks will do, the banks will make it attractive, 3.5 to 5%. And then people will think, yeah, earlier we used to get 3.5% interest, now we are getting 5% interest. So let's park our money over here. Financial instruments become attractive by the scheduled commercial banks. Scheduled commercial banks will not go to the RBI because there it is 6% interest rate to take loan. Scheduled commercial banks want the money. They will make the financial, I would say, instruments more attractive, 3.5 to 5%, and will suck in the money from people or take the money from people. People will also park their money because earlier they were getting 3.5, now they are getting 5%. So, as a result, excess liquidity in the economy reduces. Money supply in the economy reduces. Money supply reduces, inflation reduces. This is how RBI tackles inflation with changing the repo rate. So what happens to repo rate when inflation is high and RBI wants to contain it? RBI increases repo rate. Understood why? How? Then what happens then? The scheduled commercial banks make their financial instruments more attractive to suck in the excess liquidity in the economy. As a result, the inflation comes down due to less circulation of money in the economy. So this is the basic funda behind this. Now the present repo rate 6.5%. It has been unchanged. The heading was RBI keeps the repo rate unchanged. So it is unchanged. Earlier also it was 6.5%. Now also it is 6.5%. Trend of repo rate, it is unchanged since the last two times. The last, I would say, time was in June. Before that, it was in April. So every 2 months, RBI is releasing this monetary policy. Inflation target, how much inflation we have to keep? That is 2 to 6%. Actually, it is 4 plus minus 2%. So 4 plus minus 2% is 2% minimum, 6% maximum. And what index we take for measuring inflation? We take the consumer price index. CPI. Are there any other indexes for inflation? Yes, there are. One is wholesale price index, which measures the inflation at the wholesale level. This consumer price index measures inflation at the retail level, that is at the consumer level. So RBI targets that, inflation at the consumer level. The target is 2 to 6%. Present inflation is 4.81%. So it means that it is well within the limits. Earlier it was 4.3%. Now this rise in inflation from 4.3 to 4.81 can be attributed to the food inflation. We all know, tomatoes, ginger, they are all so expensive. But even despite that, overall inflation is 4.81 only, which is well within the limit. Inflation projections, 5.4% for financial year 24. Financial year 24 simply means April 2023 to March 2024. Financial year FY24 means this. So 5.4% is the projection. Present inflation is 4.81. So we should understand from this that in the coming times, inflation is going to increase. There will be more inflation in the times to come, in the third quarter and fourth quarter of FY24. This has been clearly projected by the RBI. Then, who decides repo rate? Monetary Policy Committee. Since we are reading that RBI keeps the repo rate unchanged, so a broader view of this question or a broader answer of this question, who decides repo rate? It is RBI who decides. But inside of RBI, there is Monetary Policy Committee, MPC. Monetary Policy Committee was formed in 2016. So does that mean before 2016 anyone else was deciding on monetary policy? No, it was the RBI only, but RBI did not have any Monetary Policy Committee. The top officials of RBI, they used to decide. Before 2016, RBI had two responsibilities. One responsibility was to keep the inflation in check, and the second responsibility was to keep the economic activity good. Now we need to understand one thing, and from here, by understanding this, we will deduce the fact that how RBI remained in a dilemma before 2016. Now, whenever money supply in the economy is high, inflation is high, and economic activity is also high. Money supply reduces, economic activity also reduces. So there needs to be a balance. We need economic activity also. We need to contain inflation also. So RBI had both these responsibilities, and RBI was always in a dilemma before 2016. If they went for tackling inflation, reducing the money supply, then economic activity was hampered. If they went for, easing the monetary policy, means repo rate was lowered or repo rate kept unchanged, money supply was good, so inflation was not able to, they were not able to tackle inflation, and this remained high, economic activity remained high. So there was always this dilemma. But in 2016, the government of India decided that RBI, you don't worry about economic activity. It is my job. I'll do it. You only tackle inflation. And for tackling inflation, we are forming this Monetary Policy Committee in you. The Monetary Policy Committee will be responsible for releasing the monetary policy, which will have these repo rates and all. Now, what is Monetary Policy Committee? MPC is a committee constituted by the central government and led by the governor of RBI. It was obvious that since it is under RBI, the governor of RBI will be leading it. Monetary Policy Committee was constituted as per section 45ZB under the RBI Act of 1934. The first meeting was on 3rd of October 2016, since it was formed in 2016. MPC was formed with the mission of fixing the benchmark policy interest rates. Repo rate is also called as policy interest rate, monetary policy interest rate, to restrain inflation within the particular target level. Target was 2 to 6%. The committee determines the policy interest rate required to achieve the inflation target. So, simple. The MPC is required to meet at least 4 times a year. At least 4 times a year means every quarter it is required to meet, but presently it is meeting 6 times a year because every 2 months there is this monetary policy released. The quorum for the meeting of MPC is 4 members. Actually, in MPC there are total 6 members. And quorum simply means that for a meeting of MPC to happen, at least 4 members should be present. Now, we'll look into the membership also a bit. Each member of MPC has 1 vote, and in the event of an equality of votes, the governor has a second or casting vote. See, understand that there are 6 people. Each member has 1 vote. What happens in case of 3 versus 3? Then the RBI chairman has this facility of casting vote, means whatever the RBI chairman wants, then he will again vote, second vote, and that will be accepted. Once every 6 months, the Reserve Bank is required to publish a document called Monetary Policy Report to explain the sources of inflation and forecasts of inflation for 6 to 18 months ahead. And there is also one more provision, that if this inflation is not able to remain within the targeted limit, that is 2 to 6% for 3 successive quarters, then the Monetary Policy Committee has to submit a report to the Government of India explaining why this inflation is there, what we are doing to target inflation and all. Apart from it, 2022, that is last year, Monetary Policy Committee submitted first such report to the Government of India where inflation was beyond the limit for 3 successive quarters. The report was submitted by Monetary Policy Committee in the month of November-December last year. It was not able to contain inflation for 3 successive quarters. So this happened, and that was the first time this happened in the history of Monetary Policy Committee. Last year was inflation ridden, and not only India, the entire world was suffering from inflation. Now that report which Monetary Policy Committee submits to the Government of India is separate, and this report is separate. Okay, Monetary Policy Report, it has to be submitted every 6 months. So don't get confused. Composition of the committee. The committee comprises of 6 members. We know that, including the chairman, 3 officials from RBI and 3 external members. Now, if I have to make it, this is the chairman. RBI chairman is the head of Monetary Policy Committee. So, and 5 more members, total 6 members. 3 are from RBI, this one also from RBI, this one also from RBI, and 3 are external members. These are nominated by the Government of India. Governor of RBI acts as the chairperson. He is the chairperson and ex officio chairperson. So whoever will be the governor of RBI, he will be the chairperson of Monetary Policy Committee. Members nominated by the government hold office for a period of 4 years from the date of appointment. So these 3 hold this position for 4 years. None of the central government nominees are eligible to be reappointed. These 3 people will not be reappointed to Monetary Policy Committee. Decisions are taken by majority vote, with each member having a 1 vote. So everyone has 1 vote. Everyone's vote value is 1. But in case of a tie, that is 3-3, the RBI chairman will have a casting vote or a second vote. And whatever, RBI chairman wants, that will happen. So this was the story of inflation targeting in India and how does RBI does it with monetary policy. What is the importance or significance of repo rate? Next is welfare schemes for gig workers. Now, why was this in news? Because there is absence of any specific welfare scheme by the government for gig workers and platform workers. A parliamentary panel has asked Ministry of Labour and Employment to formulate and implement welfare schemes for them at the earliest. Now, there are two terms used, gig workers and platform workers. So, gig workers and platform gig workers they are. Basically, there are many, gig workers, like I gave you the example of Zomato, Swiggy, Ola, Uber. Those workers who are working on a digital platform. A digital platform is, having more transparency, more stability, and, better, I would say, workflow. More work is there. You don't need to market yourself. They are already done that. Because you have to register yourself on those online platforms, and you will be having the work. Like for example, Ola, Uber, they have done the marketing and all people know about them. So you just have to register yourself on that platform and start driving. So those gig workers who work on the basis of the digital platform are called as platform workers or platform gig workers. And then there are other gig workers. Let's suppose you go to a labor chalk in your city, nearby area where the labor is there, and let's suppose you have to get some work in your house done, plumbing work or painting work, or let's suppose some carpentry work. So you go there, you fetch where all the laborers are there. I want that work to be done. So they'll come with you. They do the work, you pay them. They're not registered on any digital platform, but they stand there in one position or one area. From there you go and bring them. Those are non-platform gig workers, not registered on a digital platform. The life and I would say income of platform gig workers is, I would say, more stable as compared to the non-platform gig workers. So this is the difference. Both are gig workers, but the ones who are registered on a digital platform are called as platform gig workers. Those who are not are called as gig workers simply. Now, what is gig economy? Gig economy is a free market system in which organizations hire or contract workers for a short span of time, temporary, to meet the company's requirements by having short-term engagements. Startups like Ola, Uber, Zomato, Swiggy have established themselves as the main source of gig economy. Now, is this beneficial? If I say yes, it is beneficial from the employer's point of view as well as the employee point of view. People are getting more jobs, and those companies are getting people to do those jobs. They do not have to, give them the money if they do not work also. Whatever work they do, those companies are also earning from that work, and they are giving a portion of that to those people. So it is a win-win type of situation for both. But what is the problem here is that there is no welfare for the gig workers. The traditional employee of any company, the income will increase as the time passes and position will also increase. But here, in case of gig workers, there will be no rise as such, because they are not in a traditional employer-employee relationship. The person who is in a traditional employer-employee relationship will have access to multiple benefits like insurance schemes, pension schemes, paid leaves. But here, in case of gig workers, no such things or no such facilities are available. These people, if they are sick, let's suppose, and they'll not be able to go to work, they cannot apply for sick leaves and they'll get paid for it. No, that day's income is finished. So that is the main, I would say, lacuna here, or that is the main problem over here. Who is a gig worker? According to the Code on Social Security 2020, a gig worker is a person who performs work or participates in work arrangements and earns from such activities outside of traditional employer-employee relationship. They are independent contractors, online platform workers, contract firm workers, on-call workers and temporary workers. Participation in the gig economy is higher in developing countries as compared to developed economies. Only 1 to 4% work in developing countries, 5 to 12% people work in the gig economy. Most of these jobs are in lower income job types such as deliveries, ride sharing, micro tasks, care and wellness. Now when I talk about the gig economy in India, around 77 lakh workers were engaged in the gig economy, which are expected to reach 2.35 crore by 2029-30. Their average, income is 18,000 rupees per month. Average age or median age is 27. 71% are sole breadwinners of their family. They are feeding a family or household size of 4.4. Now just imagine a sole breadwinner earning this much money and feeding 4.4 people. Is this enough? And just imagine if this person falls sick for 2-3 days, then this reduces. But the mouths to eat are the same. So these are the problems. These figures clearly indicate the importance of gig working community in the Indian economy. And this is projected to increase, presently 77 lakh to 2.35 crore. So we need to take care of them right from now. Now the gig workforce in India, this is according to the Niti Aayog report. Retail, traders and sales, 26.6 lakh workers are there. Transportation, 13 lakh workers. Finance and insurance, 6.3 lakh workers. Manufacturing, 6.2 lakh. Education, 1 lakh workers. Niti Aayog report stated that 47% are in medium skilled jobs, 31% are in low skilled job and 22% are in high skilled jobs. So this is the, I would say, composition of gig workforce in India, which is expected to increase. Now challenges faced by them. While platform companies have created avenues of employment, it has often been marred by low wages, unequal gender participation and lack of possibility for upward mobility. Upward mobility will happen only when you are in a traditional employer-employee relation. Then this has triggered protests from workers at companies like Swiggy, Zomato, Blinkit and all. Gig workers are typically hired by companies on a contractual basis. They do not receive some of the benefits that an on-roll employee receives. And this means that they do not receive benefits like paid and sick leaves, casual leaves, travel and housing allowances, provident funds, savings, etc., which the traditional employee receives. Now, steps to be taken or taken. We need to consider this. This is the main, I would say, slide which will give you fodder for writing in the mains, and this topic is very much important for this year's mains. First is fiscal incentives. Fiscal incentives should be given to those companies who are hiring gig workers by the government. What kind of fiscal incentives can be given by the government to those companies? Like those companies can be given tax rebates or some input rebates. So whatever amount they save, that saved amount should be invested for the welfare of gig workers. That is the basic agenda behind giving fiscal incentives to those companies hiring gig workers. And we should also, or the government should also, put some conditions that these much or this composition of gig workers should be females. So, it will improve gender empowerment, or it will target gender empowerment as well. Then we can talk about their retirement benefits as well. Like, whatever work they are doing. Let's suppose a Zomato delivery guy is coming and delivering food. So the food is 100 rupees. Zomato's platform fee is, let's suppose, 10 rupees. The delivery charges are, let's suppose, 15 rupees. So total has to be paid 125 rupees. 100 plus 10 plus 15, that is 125. In this only, 2 rupees extra can be charged. And this 2 rupee will go for the welfare of the gig workers, which will be contributed in the gig workers pension account. Things like these can be taken so that that gig worker can have retirement benefits. Rajasthan has passed one such law in 2023. Rajasthan Platform Based Gig Workers Registration and Welfare Act 2023. But again, the lacuna here is that it is only for the platform gig workers. Non-platform gig workers who are more vulnerable are not covered. But anyways, let's see what the law is. Under the Act, a board will be established to ensure gig workers' registration and welfare, addressing their vulnerabilities and providing a platform for collective bargaining and negotiations. So a board will be there where gig workers can register themselves. That board can act as a negotiating, I would say, platform with their employers. So the board will be there. The board can serve as independent grievance redressal mechanism also. Means any complaint any gig worker has, they can file those complaints with the board. The Act also has a provision of establishment of a social security fund funded through a fee on every transaction. Now this is what I just told you, that Rajasthan has done that every transaction or every activity done by those gig workers, there should be some fee extra that can contribute to the social security of the gig workers. And now the last piece of news, that is PM Street Vendors Atmanirbhar Nidhi, which we know as PM Swanidhi. The Union Housing and Urban Affairs Ministry recently set a new target for its PM Swanidhi scheme for street vendors, that is 63 lakh loans have to be disbursed by the year end. Now to understand this particular scheme better, we need to go back to 2020. 2020, when the entire world was suffering from this new disease or the pandemic called COVID-19. India was not left behind. India was also suffering. The entire year went into lockdowns. And one of the most impacted categories of people were street vendors. Street vendors are not those businessmen. They are businessmen, they are nano entrepreneurs, but they are not those businessmen who have their, corpus with them or savings with them. They are just hand to mouth. Whatever they earn, they consume, they eat. That is it. And since lockdowns were there, so they were not able to earn. That is why one of the most impacted. What did the government of India do for them? Did the government of India give them money free of cost? No. Government of India said that take loans, pay interest on those loans, return them back, take more loans, return them back, take more loans. Get up and work. It was like this. Nothing I am going to give you for free. This was the simple and clear-cut stand of Government of India. Government of India said that first time you come to me as a street vendor, I'll give you loan of 10,000 rupees. You return it back, I give you loan of 20,000 rupees. You return it back, I give you loan of 50,000 rupees. And this is how things will go. Now, let's see more details about this. First of all, we need to understand that who are street vendors. Now, there is a law for street vendors, that is the Street Vendors Protection of Livelihood and Regulation of Street Vending Act 2014. Now, this law was passed by the Government of India in 2014 to protect the street vendors. Now, again, the street vendors are more vulnerable community, like wherever they are doing their vending work, they are made to leave that place, or they are more prone to corruption. But by the passage of this act or this law, extra protection was given to them. So every street vendor had to register themselves with the municipalities. They will not be evicted. Things like these were there. So this particular law defines who a street vendor is. Any person engaged in vending of articles, goods, wares, food items or merchandise of daily use, or offering services to the public in street, footpath, pavement, etc. from a temporary built-up structure or moving from place to place. The key is temporary built-up structure or moving from place to place. Like the vegetable vendors, they have that ready here or thela here, they go from place to place. The momo wale bhaiya, the chaat tikki pakodi wale bhaiya, they all have that thela or a stool where they put their stall. Those are temporary built up structures. So those people who are engaged in such kind of activities from a temporary built up structure or moving from place to place are called as street vendors. These are nano entrepreneurs of the country playing a very significant role. Now about PM Swanidhi micro credit scheme facilitating working capital collateral free loan. Acha, these are collateral free loans. Means you don't have to give any guarantee or anything as collateral, but interest you have to pay. 10,000 rupees, the first loan, with subsequent loans of 20,000 and 50,000, and these subsequent categories of loans will have 7% interest subsidy. Not in the first one, but in the second and third one will have 7% interest subsidy. It is a central sector scheme. Central sector schemes are those schemes which are formed by the center and implemented by the center only. On the other hand, there are other schemes like centrally sponsored scheme formed by the center and implemented by the states. Contribution by the states also is there in those schemes. Under Ministry of Housing and Urban Affairs, launched in July 2020 to help street vendors hit by COVID-19 pandemic and was to run till March 2022. But it has been extended till December 2024 because this scheme has positively impacted people and people are wanting more and more of this scheme to continue. Objectives: facilitate a working capital loan to street vendors, incentivize regular repayments, reward digital transactions through cashback facility. Now these 2 points. Incentivize regular repayments. Like I took a loan of 10,000 rupees, I paid it within stipulated time period, and then I become eligible for the next category, that is 20,000. I again repay it back and I will be getting interest subsidy. And let's suppose I am whatever business I am doing, let's suppose I am selling momos. So I am taking most of the money from UPI, digital transactions. Then there is a limit set by the government that this much percentage of money or this much percentage of income should come from this UPI transactions. Then we will give you, if this much comes, then we will give you cashback of 100 rupees per month. Maximum cashback in a year is 1200 rupees. So that cashback comes, and interest subsidy also we get if we do repayment on time. Who is eligible? All street vendors engaged in vending in urban areas before March 24, 2020. Now, as I told you, according to that law, you have to register yourself as street vendors to the local community or the local government. So, if you have registered yourself as a street vendor with the local government before March 24, 2020, you are eligible for this scheme. But there is one more condition. The other condition is that this law which was passed in 2014 with respect to the street vendors, some states have made rules, because according to that law, states had to make rules for their respective states with respect to street vending. Some states made rules, some states did not. So those states who had made rules for that particular law for the street vendors were eligible. The other were not. Okay. Now features. Now for the loan, no collateral will be taken. Studied this. On timely or early repayment, the vendors will be eligible for next cycle of the working capital loans with an enhanced limit. Enhanced limit is 10 to 20,000 to 50,000. This is the enhanced limit. Rates will be as per the prevailing rate of interest. Rates means interest rates. And if you are taking loan from non-banking financial companies, then RBI guidelines for those NBFCs will decide the interest rates. Now, this is very important. If street vendors repays the loan EMIs promptly and conducts the required number of digital transactions. So, if the street vendor is repaying the loan EMIs promptly, he will become eligible for interest subsidy. That is 7% interest subsidy. And cashback, digital transactions are done, then cashback will also be there. That is 100 rupees per month cashback. Now let's suppose the rate of interest of the loan which is given is 9%. I have taken this loan at 9% interest rate and I am paying it back timely, promptly. So 7% interest subsidy will be given. So the effective interest rate will be 2%. Then 2%, the other 2% will be compensated by 1200 rupees cashback. So technically speaking, this can be interest free. If I repay it promptly, the 7% I would get interest subsidy. The remaining 2% can be fulfilled by or can be taken care by the cashback which I am getting, 1200 rupees. This happens, I would say loan given to me will be kind of interest free. And implementing partner is SIDBI, Small Industries Development Bank of India, is responsible for implementing this scheme. So this is it from today's class. I hope this was helpful for you. We'll be meeting tomorrow with more such kind of news. Till then, keep reading. Bye bye. Jai Hind.